The stock market is telling you something right now, and most retail investors are completely missing it. Smart institutional money has quietly stopped chasing the usual suspects. No more broad consumption plays, no more NBFCs, no more India's rising middle class generic trades. Instead, they've executed a sharp pivot towards something more specific, more structural, and frankly, more exciting. Three megatrends. That's what the next 5 years in Indian equities will be defined by. And today, I'm going to break down exactly what they are, why they're happening now, and most importantly, how you should be thinking about them as an investor. I'm Sonam, founder of Wright Research. We run a quantitative PMS and have been building data driven portfolios for Indian investors for years. When I see institutional flows rotate this sharply and this consistently, well, I pay attention. Let's get into it. Before I get to the three trends, here's the macro setup you need to understand. Corporate India is fundamentally healthy. Earnings are growing, balance sheets are clean. But here's the nuance: the opportunity for alpha, returns above the market, has narrowed significantly. The market is no longer rewarding everything that's growing. It's rewarding a very specific type of company, one that has four things: visible structural demand, not cyclical, not dependent on government spending announcements; differentiated technology or manufacturing depth, basically products that aren't easy to replicate; operating leverage, the ability to grow margins as capacity fills up; and capital discipline, management that doesn't just chase every opportunity but actually focuses on high return projects. If a company has all four, institutional investors are paying up. If it's missing even one, it's being left behind. The market is essentially saying capability over capacity, execution over ambition. With that lens, here are the three themes capturing the most institutional conviction for 2026 to 2028. Megatrend 1: AI infrastructure. Megatrend 2: advanced manufacturing. And Megatrend 3: niche specializations. Let's start with Megatrend 1: the physical stack of AI. Everyone's talking about AI, but here's what most investors miss: AI is no longer just a software story. By mid 2026, the AI theme has become a physical infrastructure play, and that's where the real money is flowing in India. Think about what a data center needs. It needs power, massive, uninterrupted, high quality power. It needs transformers. It needs transmission infrastructure. It needs cooling, cabling, specialized equipment. India's electricity grid was not built for this. The grid needs to expand, modernize, all at the same time. And that's creating a multi year supercycle for a very specific set of industrial companies. Three areas I'm watching closely: transmission and distribution. Renewable energy is growing, but it needs to actually reach consumers and data centers reliably. Grid expansion is non negotiable. High voltage transformers. There's a global supply crunch here. Lead times have stretched. India's domestic manufacturers are in a rare sweet spot where demand exceeds capacity, which means pricing power and order backlogs stretching years out. And grid modernization. Data centers need stable, high efficiency power. This isn't a nice to have, it's a prerequisite. Companies that solve for power quality at scale are critical infrastructure. What I find compelling here is the compounding nature of this demand. Every new data center requires more power infrastructure. More power infrastructure requires more transformers. More renewable capacity to feed the grid requires more T&D. It's a chain reaction, and India is in the middle of it. To put that global supply crunch into perspective, look at a company like Apar Industries. They hold a massive 90% domestic market share in HVDC transformer oils. When you have that kind of dominance during a supply crunch, you don't just have an advantage, you have incredible pricing power. For your portfolio, the question to ask is, which companies in the power electronics and electrical equipment space have actual order backlogs, not just management commentary about opportunity? That's where the real signal is. India's defense sector has this historical problem that is actually morphing into an incredible opportunity. For decades, India essentially just bought its defense equipment from places like Russia, the U.S., Israel. And even when we did manufacture things domestically, it was mostly just transfer of deals, basically someone else's design, and we just assembled it here. But listen, that era, it is ending, and it's ending fast. The new government mandate is super clear: indigenize, build it here, own the IP. And as India's geopolitical footprint continues to expand, With the India Pakistan border tensions earlier this year being just one recent example, the urgency behind this shift has absolutely intensified. But here is what makes this trend genuinely interesting from an investment standpoint. It's not just the pure play defense companies that are benefiting from this. We're actually seeing auto ancillary companies, the exact same companies that make precision components for the automotive sector, diversifying aggressively into defense and aerospace. So you might be asking, why? Why the crossover? Well, it's because the engineering depth required for a modern automobile and for defense electronics is totally converging. Complex manufacturing, incredibly tight tolerances, deep electronics integration, these are skills that directly transfer over. Think about it this way. If you are already making highly sophisticated components for a premium German car manufacturer that requires sub millimeter precision and zero defect delivery, well, you already have the manufacturing culture and the capability to serve the defense sector. And this creates a really interesting dynamic for us as investors. You're not just buying defense exposure anymore, you're buying companies with multiple distinct growth engines. That defense diversification acts as a brilliant strategic hedge right on top of their existing auto or industrial base. Now, the key differentiator in this space is no longer just about who can win government contracts. It's about whether you actually own the IP. Are you doing genuine ground up R&D or are you still fundamentally dependent on someone else's technology? The companies that are actively moving up the value chain, pushing toward indigenous design, developing proprietary electronics, and mastering systems integration, those are the ones that are going to command a lasting premium in the market. And here is a question worth sitting with today. As India's defense exports really start growing and pushing into U.S and European markets, which of these companies actually have the quality certifications and global partnerships in place to capture that demand? All right, moving right along to Megatrend 3, EMS or Electronics Manufacturing Services, climbing the value chain. Let me tell you something right now that should make absolutely every investor pay attention. The world is actively trying to reduce its heavy dependence on China for electronics manufacturing. And look, that's not just some geopolitical opinion. It is a hard supply chain reality that literally every major global corporation is acting on right now. Now, India is clearly one of the primary beneficiaries of this shift. But, and this is a massive but, not all Indian EMS companies are going to benefit equally here. To understand why, we have to look at the value chain in electronics manufacturing, going from the lowest margin up to the highest. So, at the very bottom, you have simple assembly. This is basically putting component A into slot B. It's low skill, low margin, and very easily commoditized. Moving up a step, you get into PCB manufacturing and component production, which requires a bit more capital and precision. Higher up still is original design manufacturing or ODM. This is where you aren't just building someone else's design, you're actually designing the product yourself. You're on the blueprint. And finally, right at the top, you have box builds. These are fully integrated, highly complex electronic systems. Box builds are the highest margin and, frankly, the hardest to replicate products in the entire sector. The Indian EMS companies that are just sticking to simple assembly, I mean, sure, they'll get some of the macro tailwind, but their margin upside is really limited. The actual real value creation is happening at the companies that are actively investing in PCB localization, in ODM capabilities, and in complex industrial electronics. So, what's the single most important metric you need to track in this sector? It's their customer mix. If an EMS company's revenue is heavily concentrated in high complexity, high margin customers, well, that is exactly where operating leverage really kicks in. And just think about the perfect timing of all this. India's PLI schemes are stepping in to provide the capex subsidies, right while the global mandate for supply chain diversification is flooding the market with demand. If India's EMS players can successfully execute on this move up the value chain, the re-rating potential for these stocks is absolutely significant. Growth. Okay, so we've seen some absolutely incredible growth drivers today, right? The B2B shifts, data centers, indigenous defense, high margin EMS. But let's take a stark pivot for a second and break the euphoria. What could actually derail this? What macroeconomic realities could threaten these incredible pillars when global pressures meet these local ambitions? Now, I'd be doing you a disservice if I didn't address the risks. The Middle East situation continues to create logistics headwinds. If you're in defense exports or industrial companies with global supply chains, that matters for visibility. Raw material inflation is real. Companies that can pass through commodity cost increases and maintain credible margin expansion will separate themselves from those that can't. And frankly, with these themes, execution risk is significant. The structural demand is there, the policy tailwind is there, but transforming policy opportunity into actual earnings delivery is where many companies fail. This is why stock selection matters more than theme selection. The theme gets you in the right neighborhood, but the wrong company within the right theme can still destroy returns. So let me ask you directly, which of these three megatrends do you think has the most upside over the next 5 years? Data centers and AI infrastructure, defense indigenization, or EMS climbing the value chain? Drop it in the comments. I read them, and genuinely, the split between these three tells me a lot about how investors are thinking about India's next chapter. If you want to see how we're positioning across these themes in Wright such as quant portfolios, that's what our PMS is built for. We're not guessing based on narratives. We're running the numbers on which companies in these spaces have the actual financial characteristics to outperform. Link is in the description. And if you found this useful, share it with one person who's trying to figure out where to invest over the next 5 years. That's genuinely the best thing you can do to support this channel. See you in the next one.